Hey everyone, in this video, I'm going to bring you two Warren Buffett ETFs that you can buy hand over fist for 2024. But not just that, I'm going to show you how to evaluate ETFs, what to look for, what to avoid looking at, and give you my strategy for investing in ETFs for 2024 and beyond. So this is an exciting video. I'm excited to share this information with you. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the two Warren Buffett ETFs we're going to look at in this video is the SPY, which is the Spider S&P 500 ETF Trust, and Vanguard S&P 500 ETF, each of which Warren Buffett owns roughly 16.8 million shares in. So let's take a look at Vanguard first, the VOO, Vanguard S&P 500 ETF. So first of all, ETFs try to mimic the returns of a broader market. So in this case, the VOO is trying to copy what you would get if you invested in each of the S&P 500 stocks. So if you had all 500 of these stocks, what would your return look like? This index tries to copy that. And the reason it exists is to save you the trouble from going and individually buying each one of those 500 stocks and weighting them appropriately to give you the proper balance and the weighting of the S&P 500 index. So that's what it does, and it earns a fee for that service. That's one of the first things we're going to look at. One of the more important things you want to consider is the expense ratio. For Vanguard S&P 500 ETF, it's 0.03%, a very low and favorable ratio, one of the lowest you will find in the industry. You want to find ETFs with a low expense ratio because this is coming out of your returns. And so you don't want this rate to be higher because that means more of your returns will be eaten up by the expense ratio. The market price, surprisingly, is something you can ignore. Now, you might be surprised at that statement. The reason you can ignore the market price because most brokerages will allow you to buy fractional shares. So if you only want to invest $100 in the Vanguard S&P ETF, you can spend only $100. You don't have to spend $436.93 to buy one share. You can buy a fractional share. And so the market price is irrelevant in my opinion. It doesn't matter where it's at because you can always buy a fractional share if you need to. What is also important to look at is the fund's historical returns. So here there's the VOO compared to the benchmark, which is not here. But what you could see is since its inception of September 7th, 2010, this fund has returned 13.87%, which is an excellent average annual return, right? And in the recent 1 year, it's brought you 26.25%, 3 years 9.96%, 15.65% in the 5 years, and 11.99% in the 10 years. So this is important to look at. This will give you an idea of what this fund can give you over the next time period. So if it's given you 12% over the last 10 years, it's reasonable to assume it can give you average annual return of 12% for the next 10 years, right? That's a reasonable assumption, especially the longer history you have. 10 years is not that long of a history for an index fund. The longer history you have, the better indicator of what the future performance could be. Now, the last 10 years have been an exceptionally good 10 years for the stock market, so the next 10 may not be as good as the previous 10. It's just a reasonable assumption to make when you're looking at a projected return from an ETF. So this is an important thing to also consider is the index fund and its beta. Now, what the beta is, here we have the beta of 1 against the S&P 500 index and a beta of 0.98 against the Dow Jones Total Stock Market Index. The beta measures the relationship between this index fund and the S&P 500 index. That means if the S&P 500 index increases by 15% and the beta is 1, then your fund will increase 15%. It'll move like for like with the S&P 500 index. There won't be any drop off or increase above what the S&P 500 gives you. And that's a good thing when you're trying to mimic the S&P 500. You want something that copies it as closely as possible when you're looking at an index fund. You're trying to find something that copies that index. And this fund does a good job in copying the S&P 500 index. Okay, another important thing to consider is the style box, which is the investment style and market capitalization of the fund that you're buying. This fund in particular, the investment style is blended, so it's a mix of value stocks and growth stocks, and it's weighted more towards large cap stocks. So it's a large cap blended fund, okay? So that depends, is whether it's good or bad, depends on what you're looking for. If you're looking for a large cap blended investment, then it's good. But you might be looking for a small cap value fund. Well, then this index fund would not be right for you. You would want to find one that offers you a mix of small cap and value stocks. And there are funds that are existent that will give you that. But this one in particular is large cap and blended, a mix between value and growth. And so if this is what you're looking for, then it's right for you. But it's good to check this to make sure it matches what you're looking for. So more important than looking at the market price is looking at the PE ratio of the fund. Right now, it's trading at a price to earnings ratio of 23, which is on the expensive side in terms of valuation. And I highlighted earlier that the stock market has had an exceptionally good previous decade. It's had an exceptionally good year in 2023. So valuations are a bit rich. And so that could make a difference whether you want to start investing in this index fund right now, or if you want to wait for a dip in the valuation in the stock market to start accumulating your position. My advice would be not to do that. And here's where I'll share my strategy for investing in index funds. My strategy for investing in index funds is to take your allocation and split it up into 12 and make a monthly purchase. So let's say your plan is to invest $12,000 per year. My strategy for that would be to split it up into $1,000 increments and buy $1,000 worth of VOO every month for the 12 months, regardless of where valuation is. Try to set it up on automatic, where it just automatically purchases the index fund for you on a certain date every month. That way you're not looking at valuation, you're not looking at prices, you're not trying to chase momentum, you're not trying to buy the dip. You're just with discipline investing every month. And over the long term, if you do that every month for every year for the next 20, 30, 40, 50 years, you're going to end up accumulating a massive amount of wealth. That's the key strategy, to not try to time the market. That's not really a strategy that works very well, but to be disciplined, contributing every month for every year for the next 20, 30, 40, or however many years you have left in your investment time horizon. That's been proven to be the most effective strategy. That's the strategy I would take, and that's the strategy I take in my portfolio where I have index funds. Okay, and the other last thing I'm going to highlight to look at when you're investing in an index fund is the distribution of holdings. What is the fund invested in? And here you have a breakdown of where this fund is invested in the sectors. So 8.6% in communication services, 10.7% in consumer discretionary, 6% in staples, 4% in energy, 13% in financials, and so on and so on. So you get a breakdown of where the money is invested within the fund, the stocks within the fund. And so then you get a more specific breakdown in what the fund is invested in. So you have 7% of the fund is in Microsoft stock, 7% in Apple stock, 3.4% in Amazon, 3% in Nvidia, 2% in Google, and it'll break down all 504 stocks it holds. It breaks down the percentage of that. And so you want to take a look at that and make sure you're comfortable with what you're getting. So you're getting that mix within that fund. That's what you're buying. You're buying in that fund that you're buying, 7% of it is Microsoft. So when Microsoft stock does well, the fund will do well. When Apple stock does well, the fund will do well. So each of these stocks contributes to the overall fund. It's an important thing to look at. Okay, so now that we looked at all the important things, let me briefly cover the S&P 500 index. And we're going to look at the same things here. We're going to look at the expense ratio, the breakdowns, and the same things we were looking at with the VOO, except it's a different fund to consider. So this fund has a expense ratio of 0.04, above the 0.03 of VOO. So VOO has a lower expense ratio. So the top 10 holdings of this fund is Microsoft, Apple, Amazon, Nvidia, Alphabet, Tesla, Berkshire Hathaway. So very similar to the VOO, although not exactly similar. And then you get the breakdown of the sector allocations, technology, financials, consumer, a breakdown of all of that. And then you also get the historical performance. The 10-year performance of this fund is 11.94% compared to the category of 11.54%. So this fund has done better than the category overall. So these are excellent index funds, in my opinion, to start your long-term investing career. You add, like I said, you use that strategy that I said of, you can call it dollar cost averaging, you can call it disciplined allocation, whatever you want to call it. You just break down the amount you want to invest every year, and you break it down into 12 pieces, and you make 12 investments every year on a certain day. You make that investment every month. Don't let the price discourage you from investing, and don't wait for a dip, and don't chase momentum. Just with discipline, add a little bit of each of these funds to your portfolio, and I promise you, over 20, 30, 40, 50 years, you will give yourself a very good chance to increase your wealth in that time. Now, it's no guarantee, but you are increasing your chances that you will become wealthier with this strategy. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.